Hello guys, I'm so sorry for the late upload, okay? Mainly because the internet connection in Phuket is totally unreliable. As I was recording halfway, it will like disconnect and then there's a lot of issue lah, and I can't even upload properly onto YouTube also. But anyway, right, this is a re-recording because I'm finally back in Singapore and there are a few things that I've looked through over the past one day, right? I think there's a lot of development, mainly from the earnings itself, lah. Okay, so there are quite a number of important stuff I want to go through today. Hopefully you have the time to watch this watch this whole thing, lah. Okay. So firstly, right, in the beginning of the year, the previous webinar, lah. Okay, in the previous webinar, right, I have mentioned that overall I am kind of like a little still on the bullish side lah, okay? But currently I will shift my stance to more of a neutral position than a bullish position, but it is by no means very, very bearish also. Okay, so there are a few developments that make me want to think this way. And some of the stuff, right, is mainly the earnings lah, okay? So the additional thing that came in from the last webinar to this webinar is actually the bank earnings. And in fact, the bank's earnings are not really very, very good. But aside from bank's earning, there are a couple of other companies' earnings that also came out. And so far for this earnings season, things are not looking that great now. Okay, so now let me just go through some of the stuff that I want to share. So firstly, the main thing is the overall market itself lah. Okay, so you can see the market kind of like shoot up all the way from October until like right now. Even right now, in the past few weeks, right, you see market kind of rebounded a bit and then it is now retracing back down, okay? But the main rally came in during after the October FOMC, and then on the November CPI data, right? When November CPI data came out, the CPI data was below expectation, and then the market just rocket to like a all-time high level. You can definitely see from Nasdaq also, where you can see this November 14, this particular candle here, right? The market just broke through the resistance and it went all the way to all-time high that level. But as we look at the CPI data last week, it seems that overall the CPI data seems to be above the consensus by quite a bit. It was above the consensus by 0.2% now. So because of that, you can definitely see the 10-year yield rebounding back up. So currently right now, right, you can see from the last week of December 28, right, the 10-year yield actually kind of like go back up a bit. And you can you can see that definitely reflected in our stock market also, where from last year, 28 December, until like to the first week of January this year, right, the market actually went down. Then after that, the 10-year yield kind of like relaxed a bit as it came back down, right? The market recover, and then right now the yield is bouncing up quite aggressively again, and then you see the market actually kind of like showing some red candles in the futures lah. Okay, so overall the market is still somewhat a slave to the yield. It is still very, very responding to what the yield is doing lah. But right now we have another big factor that is coming in, and that is the earnings season. So the reason why I want to share about yields is that we can definitely justify the rally that happened within the last 2 months, okay? November and December, this big rally that went up. So that big rally, right, is definitely because of the yield coming down aggressively, and mainly because it's due to Federal Reserve saying that they are done with the rate hike, and then most likely they are going to cut next year. In fact, for next year, right, they have projected a full 1% cut. Currently, right now, the federal fund rate is at 5.5%, and by the end of next year, right, they are targeting around 4.6%. So it is about a full 1% cut, okay? So because of that, the market actually rallies. So the market kind of like priced in this cut already. The market actually sort of assumed that this cut is going to happen. So one of the question I received, like, how am I able to tell if the market has been priced in, right? Wait, let me kind of like hang on, because I got I got private stuff on my Discord. Let me stop share for a moment. Okay, and we're back. So now, one of the things that I would like to look at is also the financial condition now. Okay, so the financial condition kind of like let you know how easy or how what is the ease of accessing the capital market, whether or not you can get new loans or whether the bond yields are going down, right? So that is the financial condition. So the more the financial condition is, right, the more you see the blue color line going towards the left side. It's actually more bullish for the market because the market is able to get new loans, or the market is expecting that in the future, right, they will be able to get capital very, very easily. So due to that, right, the market tend to be very, very bullish. So you can see that in the last month, right after Federal Reserve announced their plan for pivot, right, you can see how much the financial condition have eased. And it is almost equivalent. It's almost equivalent to the easing during the 2008 QE after the big housing crisis. And of course, it doesn't reach the level of the 2020 QE lah. Okay, but it is somewhere there. It is somewhere there. So right now, the market is behaving as if, right, we already have a QE, even though we don't have a QE yet. In fact, we are still in QT lah. Okay, Federal Reserve is still unloading their balance sheet. So the market is kind of like way, way, way ahead. And that's the reason why the market rallies so much. But if going forward, right, if the overall economy is not that great, and if the earnings are quite disappointment, right? If the if the earnings come out and if they are not that great, right, then this whole thing can actually go back down, whether or not there's rate cut or not, doesn't matter. I think with the earning result, right, I do believe that there's a chance this whole thing can actually U-turn back down. Okay, so and the reason why I'm saying that is that for all the company which earnings have came out, right, they are not really looking to be quite promising. And there's another thing that I'm also looking at is because the market is also reliant on the overall the job market. Okay. So even if the interest rate is high enough, right, as long as people have their job, as long as people are working, they can still tide through this whole thing. So this strong job market, right, it is also a very, very big factor in keeping the stock market alive. So, but the thing is that even though unemployment rate is currently quite low, somewhere around 3.7, I think the last reading was 3.7%. But overall, right, I was looking at the United States average weekly hours, right? Like what is the number of hours that people are working. So it is also a good indication of how healthy the job market is. And you can kind of see that we are back to pre-COVID level already. So during the COVID period, right, you can see how the weekly hours spike up all the way until 35 like that. But it has now retraced. It has now gone back down to the normal level. Okay, which means that the job market right now kind of like normalizing already. So it is an indication that maybe the job market is also cooling. So if the job market is cooling and if the earnings are not that great, right? And since the market have already priced in the rate cut, then any bad development coming that is going to come out in the future, right, it is going to dive the stock market to the downside, because we cannot simply just close our ears and rate cut, market gonna go high, market gonna go high. We cannot have that kind of mindset. We cannot have that kind of analysis, mainly because it has been priced in already. So any new development that is not good, right, it is going to override the rate cut news. Okay, so this is one indicator that I'm looking at. But the other indicator is also, I like to look at this particular report during the earnings season. It gives me like a overall summary of how the earnings season is. Okay, it is by FactSet. You can actually go and Google FactSet earning insight and you'll be able to get this. So it kind of summarized the whole earnings season, meaning to say that I don't have to go and individually take out my Excel spreadsheet and see how many companies miss their earning, how many beats their earning, what is the growth, all this kind of stuff. Okay, but here, right, I want you to take a look at a few things, a few important part. So now, the important one is important one is this portion here. For Q1 2024, okay, this Q1 really lah. Okay, sorry. we are actually currently this earning is for Q4 lah. Okay, Q4 2023. So the forward 12-month PE ratio for S&P 500 is 19.5. So this is PE ratio, and this is forward PE ratio. Okay, this is not a trailing 12-month PE ratio. Our forward PE ratio is very important because it is letting you know what is the market pricing ahead, not what it has priced in the past. Okay, so now this PE ratio is actually above the 5-year average 18.9 and above the 10-year average 17.6, meaning to say that the market right now have actually priced in somewhat a higher level of earnings than it used to be lah. Meaning to say, right, whenever earnings come out, the earnings have to be how do I put it? The earnings have to match up to the expectation of the market lah. Okay, because if the earnings is quite low, right, then S&P have to actually go down in order to sort of get a normalized PE ratio lah. Okay, so now a few other things here that I want to highlight. Okay, so here week one. Okay, week one of 2024. This whole portion quite important lah, and we actually care about EPS guidance, or EPS mean your earnings lah. Okay, your earning guidance is that a lot of our process by which we choose what stock to long, what stock to short, right? We actually look at the EPS guidance. How is the earnings being guided? It is being guided up or it is being guided down. So that is our main mode of choosing what stock to trade lah. Okay, so now let's take a quick look at this page here. While analysts revise earnings estimate for S&P 500 companies down by a larger margin for Q4 relative to recent average, have more S&P 500 companies issued negative EPS guidance than average for Q4 as well? So the answer is yes. Both the number and percentage of S&P 500 companies issuing a negative EPS guidance for Q4 2023 are above their 5-year and 10-year average. So now if you think about this, right, the number of companies that is providing negative EPS guidance, meaning to say they are going to see a lower EPS compared to the previous year, is actually higher than their 5-year and 10-year average, meaning to say more companies are expecting lower earnings. But at the same time, right, if you look at what I have shared above, the forward PE, right, the forward PE is actually above the 5-year and 10-year average. So what this means is that either the S&P 500, the stock price of the S&P 500 have to come down, or the earning have to improve. But in this case, right, the earning has already been guided down. So the only possible path forward is for the S&P 500 to come down lah. Either that, or when the actual earning for all these companies come out, right, they actually have a surprise beat lah. Okay, surprise beat as in we expect the earning to be negative, but in fact it actually come out very, very positive. So either we have a surprise beat which will justify the forward PE ratio, or the earnings actually follow very closely to the guidance, which means the S&P 500 price have to come down now. Okay, so overall 111 S&P 500 companies have issued their EPS guidance for the fourth quarter. So now this one is just letting you know the number of companies have provided the guidance now. Okay, so compared to the 5-year average and the 10-year average, the number of companies providing guidance is higher lah. So now of these 111 companies, right, 72 have issued negative EPS guidance, and only like 39 have issued positive EPS guidance. Okay, so which means to say that there are a lot of companies that are giving earnings that is lower than previously what they have issued lah. So so because of this, right, it's not looking that great also. So you can actually, if you are free, you can actually go and read here what do they mean by guidance lah. Okay, but I'm not going to go through that. So now we are into the first week of earnings already, right? So as of today, as in week 2 lah. Okay, we are actually in week 3 already. So so as of today, right, some of the company earnings have already come out. And based on what we have seen so far, right, you can see here how are the numbers trending to date. So overall, on average, the earnings for Q4 2023, right? It is the earnings surprise lah. Okay, for Q4 2020 of 2023, right? It's doing quite bad. It's actually doing quite bad to almost like the past, I don't know, past all this data trend all the way back to 2019 lah. Okay, meaning to say for this particular quarter, right? The amount of company that is missing their guidance, meaning to say they will earn this much, but in fact they earn a lot lesser, is actually quite a lot. The amount of surprise miss is around negative 9.8% lah, meaning to say that majority of the company whose earning already come out, right, they are not meeting the guidance. So now, right, since the company's earnings are missing the guidance, and then the guidance itself is already a negative guidance, right? It kind of give us a very bad sort of like a situation here, lah, okay, in terms of this current earnings season. But but of course, there are some caveat to this, and the caveat is that right now the only a couple of sectors earnings have come out lah. Okay, mainly the banks and the airline sectors lah. So from what we have seen so far, the bank and the airline sectors are not doing quite good. But let's say once the tech sector's earnings are out, once the consumer discretionary earnings are out, and if they have a surprise earning beats, right, then of course this may recover lah. But so far what we are seeing right now is somewhat negative lah. Okay, so hopefully that will give you a little bit of insight into how's the macro condition, how is the overall earnings reports, the earnings result are like taskbar lah. Okay, so let's take a look at some of the earnings that came out. So we went through the bank's earning on Friday already lah. Okay, so as we look at majority of the bank's earning, right, only JP Morgan was quite okay, but even then JP Morgan also missed their earning. You can see initially Friday they get up, it was rallying up, but eventually closed down. Wells Fargo also closed down. Citi kind of like not here not there lah. Okay, wasn't really a very big rally also, but I mean it's somewhat flat lah. So Bank of America also like down by 1%. Of course, it kept down a lot more, but eventually it managed to recover a bit, but overall it is still negative lah. Okay, so I think Morgan Stanley is coming up today later, if I'm not, later if I'm not wrong. But overall the bank's earning not really that great. They are losing a lot of money on their fixed income side, and not only that, they have increased their provision of credit, which is usually not a great news also. And another sector's earning which has come out recently, it's actually the airline sector. So airline sector is also like a good indication of consumer spending lah. Okay, so you can see Delta Airline is down by 8.9%. And of course, Delta Airline earning came out lah. Okay, but as Delta Airline went down, right, American Airline also went down, even though the earning is not out yet, right? Based on how Delta Airline is doing, the market expect American Airline to do quite bad also lah. Okay, so American Airline also went down in price, and you can see FedEx itself dropped quite significantly, but the FedEx earning was out in 19 December lah. Okay, it was out quite earlier, but you can see how bad the earnings was. So we have FedEx is also a very good indication of the overall health of the economy itself, because if they are not doing well, right, meaning there are less stuff flying around, there are less stuff being shipped around, meaning consumer spending not that good. You can infer from these kind of stuff lah. Okay, so because of this, right, like all these little bits of pieces here and there all add together, right, I do feel that most likely I will be taking a neutral approach rather than a rather than a bullish approach, but it doesn't require a huge change into my portfolio lah. Okay, so what do I mean by that is that my current intention was to have my current intention with my portfolio is to, sorry, previously my intention with my portfolio is to have a 5 long 3 short position, but right now as I'm going into neutral mode, right, what I'm going to do is I'm going to take a 4 long 3 short 4 long 4 short portfolio lah, okay, or it can be 3 long 3 short also, depending on how many trade I can find lah. So in this case, right, I only need to reduce my long position by 1 and increase my short position by 1. So it's not like I need to like exit everything I have and then enter all the short position I have. In fact, we do have a couple of short position already, so we will just let those short position be lah. Okay, we will add more and more short position on it. So now, in terms of short position, right? Previously, I have mentioned what's that? Blackstone Mortgage Trust. Okay, so now I'm going to enter Blackstone Mortgage Trust today later. I will set up the trade setup. And the other one, right, which I mentioned in last Friday webinar, it will be one of the regional banks now. Okay, so I don't expect the regional bank to do good. Also, in fact, they may do even worse than the major banks like Bank of America or Wells Fargo style. Okay, so one of the bank that I have highlighted even a long time ago before the bank's earning come out, right? It's actually Zion Bangkok. Okay, so among all the regional banks, right, I somewhat feel that this is the weaker one. So I'm not really going to go through the overall reason why I feel this is the weaker one, but even you can see the news here already. Okay, so the loan demand is quite weak, but on top of that, the makeup of their overall bank portfolio is also quite weak. So they are going to miss on their loan demand, they are going to miss on their fixed income. So I'm not sure where is their growth is going to come from. Okay. And in fact, in the past few weeks, right, this rally here is actually giving us a very, very good opportunity to short at a safer level at the higher up also. Okay. So this will be our bank of choice in order to short for the regional banks. But for Zion, right, the earning is going to come out on 22nd of January, which is next Monday. But before Zion earnings come out, there will be a lot of other earnings that is also coming out this week. Okay. So in fact, right, we may not even need to wait for next week for Zion to move. As some of the regional banks earning come out, we may see Zion already start to go down. Okay, somewhat like American Airline like that. Like the earning not out yet, but based on what Delta Air is doing, right, American Airline also fall down. Okay, so right now I have 2 additional shots that I'm going to add from Zion Bangkok, and the other one is the Blackstone Mortgage Trust. Okay, so now let's take a look at my portfolio. So my portfolio, right, currently I only have a AMR short position, which is an option position. Okay, so I'm going to add I'm going to add 2 more short, which is the Blackstone, and another one is the Zion Bangkok. So with that, right, I will have 3 short position ready. On top of which, I will say this Micron, right, Micron most likely going to burn now. Okay, but because the option is going to expire this Friday, and I don't think Micron will be able to go past $90 by this Friday. So let's just take a quick look at Micron. Okay, here, okay. So Micron is very, very far from $90, okay, unless some miracle happens during like Thursday or Friday, which I don't think it will. But anyway, right, Micron, initially when we took the trade was in profit around this level, but as it retraced and as the time decay start to kicks in, right, the time decay start to accelerate, the trade is in a loss but of course, when we enter Micron, right, it was entered as a speculative trade, and instead of taking profit when it was in the green, right, I consciously make the decision to just hold it because I was greedy okay. But I mean that's part of my trade plan. So I mean, I don't feel that I am in a loss because I didn't TP when it was green okay. So Micron is going to be gone. So after Micron gone, right, on my long position side, I will still have First Solar, I will still have Disney, and I will still have on holding. So 3 position okay. So I don't really count Allergen because Allergen to me is like not really like a trade in a sense that it is a short squeeze trade that I'm intending to hold forever okay, until the short squeeze happen. So so I kind of not I kind of don't include this as part of my strategy, okay? So it is like by itself. But even then, right, if I were to include, right, what I will have is I will have 4 long position. With Micron gone, I will have 4 long position and 3 short position, which is somewhat very neutral, okay? So without allergen, then I will have 3 longs and 3 shorts, which is fine. I think 3 long, 3 short position right now is good because we are still at the early stage of the earnings. So if eventually, right, eventually when the tech earnings come out and the tech earning, they have a very, very strong earnings, they beat the expectation by a big amount, and then we actually still have enough position in our portfolio to pivot to a bullish position, bullish bias again. So for example, I have 3 long, 3 shorts right now. If let's say tech earnings is good, I can add 2 more long position, which will make my portfolio 5 long, 3 short. But if let's say tech position come out very jialat, right, then I can add 2 more short position, which will make my portfolio 3 long, 5 short. So holding a 3 long, 3 short right now give me a lot of maneuverability. At the same time, right, I am not risking a lot also since I only have 6 position instead of 8. I have 6 position worth of risk instead of 8 position now, okay? So that is my current plan for now. So I do hope that going forward, both the Blackstone and the Zion will like give us a few good profits run, and then when the tech earning come out, and then we shall see whether if we want to pivot towards the long side or not lah. Okay, so that's actually all I have for this session. Once again, I want to apologize for the late upload, but later the trade setup will be going out, so make sure you take your trades as they come in lah. Okay, have a good day, everyone.